Welcome to the AI Floor Trader, your premium Friday market wrap-up. I am your host, and this week, the market underwent a violent, undeniable structural shift. We are officially witnessing the exact moment the artificial intelligence revolution migrates out of the cloud and violently collides with the physical world. The overarching narrative dominating trading desks from Wall Street to Silicon Valley is what we call the physical AI energy squeeze. For the last 3 years, the capital flowing into AI has been obsessed with compute and software. We saw it again this week. Meta rolling out new AI tools, Databricks unveiling their Unity AI gateway, and agentic AI making massive breakthroughs in medicine. Even Amazon Web Services flipped a switch, adding an AI traffic monetization capability to their firewall, allowing content owners to charge AI bots for access. The software layer is evolving at breakneck speed, cemented by the new 2026 Global AI Jobs Barometer from PwC highlighting surging demand for AI-literate workers. But here is the trillion-dollar reality that shifted global markets over the past 5 trading days. You cannot run an agentic AI ecosystem on hopes, dreams, and code alone. You need massive, uninterrupted baseload power. And the legacy grid is breaking. That is why the most critical market-moving headlines this week came from heavy industry and the United States Department of Energy. Hitachi Energy just made a massive strategic investment to bolster the North American regional transformer market. Why? Because you cannot build a gigawatt AI data center without transformers, and wait times for those critical components have skyrocketed. Capital is waking up to the fact that the AI supercycle is now governed by the laws of physics. Simultaneously, the Department of Energy unleashed a coordinated wave of initiatives that screams panic over national grid capacity. We saw massive federal backing for enhanced geothermal systems, commercial buildings integration, and a doubling down on the civil nuclear credit program. We even saw Energy Fuels receive conditional U.S. government support to radically accelerate domestic growth in rare earths and critical materials. Washington and Wall Street have finally aligned on one undeniable truth. Whoever controls the power, the copper, the uranium, and the physical grid infrastructure controls the ultimate future of artificial intelligence. But this explosive, capital-intensive infrastructure boom is hitting a massive macro wall. The broader economic backdrop took a dark, volatile turn this week as the war in Iran dramatically intensified, triggering a violent price squeeze across the global energy sector. Inflation is jumping right back up. The Federal Reserve is watching this geopolitical supply shock closely, and they are reacting. The signals coming out of the central bank are overwhelmingly hawkish. The US dollar is surging as a safe haven and a high-yield asset. This collision, an AI-driven energy supercycle smashing head-on into a resurgent inflation narrative driven by war in the Middle East, is the absolute story of the week. Let us break down exactly who rode this wave and who got caught in the undertow. The undisputed winners this week are the hard asset infrastructure plays. Companies manufacturing high-voltage transformers and advanced data center cooling systems are seeing unprecedented order backlogs. Energy Fuels and the broader rare earth materials sector caught a massive bid on the back of government support. Nuclear energy providers, uranium miners, and geothermal companies are being treated like premium high-growth tech stocks, riding the tailwinds of the Department of Energy's new mandates. We also have to put Amazon Web Services in the winner's circle. By letting content owners charge AI bots for access, AWS created a brand new monetization layer, positioning themselves as the ultimate toll collector in the AI economy. On the flip side, the losers took heavy hits. Gold investors got absolutely punished. The hawkish Fed signals, and the suffocating strength of the U.S. dollar have derailed the gold bull thesis for now, marking its 3rd consecutive weekly loss. Furthermore, non-profitable tech is getting squeezed from both sides. Rising inflation from the Iran war is crushing operating margins, while a hawkish Fed keeps the cost of capital dangerously high. Finally, with California admitting it utilized high-risk AI systems without reporting them, AI companies lacking ironclad governance frameworks are rapidly becoming toxic to institutional capital. So, where is the institutional alpha rotating next? The smart money is aggressively front-running the AI infrastructure bottleneck. Hedge funds and private equity giants are no longer just looking at semiconductor designers. They are buying up the physical, dirty supply chains those chips desperately rely on. First, they are heavily tracking the nuclear renaissance. With the Department of Energy pushing civil nuclear credits, smart money is mapping out small modular reactor supply chains and locking down uranium assets. The flagship data center of 2028 will need its own dedicated nuclear or enhanced geothermal power source, and capital is flowing into the providers of that baseload power. Second, institutional investors are obsessively tracking AI governance and enterprise compliance. With California's regulatory missteps and Pew Research showing shifting American sentiments toward AI, the Wild West phase is over. Databricks rolling out their Unity AI gateway is exactly the enterprise-grade infrastructure smart money wants. The next massive software valuations will go to companies building the security, auditing, and monetization layers around generative models, because that is where the sticky recurring revenue lives. Finally, with the Iran conflict escalating, big desks are watching the geopolitical premium on raw materials, rotating out of globally exposed consumer brands and into localized, defensively positioned hard assets. Looking ahead to Monday's opening bell, the setup is incredibly volatile. You need to be positioned defensively, but ready to strike. The number one trigger to watch is the crude oil futures market at the Sunday night open. Any further military escalation in the Iran conflict will gap oil higher immediately, translating into hotter inflation expectations and an even more hawkish tone from the Federal Reserve. If energy spikes, expect the dollar to catch another massive bid, putting intense downward pressure on gold and long-duration equities. You also need to watch the utility and industrial sectors right out of the gate. With Hitachi Energy and the Department of Energy signaling a coordinated grid build-out, look for momentum in electrical equipment manufacturers and rare earth miners to carry over strongly into the new week. The AI trade is no longer just about buying the dip on software. It is about buying the physical grid. Do not get caught off guard as this structural rotation accelerates. If you want to stay ahead of the institutional flow and track the smartest money on Wall Street, make sure you hit that subscribe button, turn on your notifications, and join us every single Friday. Capital goes where it is treated best, and we follow the capital. Have a great weekend, and I will see you on the floor next week.